Alrighty, we are live. Welcome, welcome, welcome to another Properties and Beers. You know, right now, middle income Australians are being pushed out of the property market, and most people don't even realize it's happening. Crazy, right? So, over the last 6 years, homes priced between 500 and 600,000 have dropped to less than 1% of new stock. Back then, 5, 6 years ago, the average home was, it was at 700, 800. But it was quite easy to find homes around that 5 to 600K range. Hell, I remember like 6 years ago, someone came to my house and said, not house, sorry. We had someone to come to one of our offices and say, "Hey, Goro, I want to buy a house. But it's going to be like 300,000." And they were out there. I wouldn't have recommended it at that point in time, and I certainly didn't recommend her. But certainly, I had clients buying property at like 400,000, right? 420, 440, and in the last 6 years, they've gone from 5 to 600,000 to less than 1% of new stock for that range. Meanwhile, properties worth over $2 million have doubled. And guess what? The majority of new builds today, that's right, over 50% of new builds today are over $1 million. So if you've been wondering why it feels harder to kind of get into the market, you're not imagining it. And tonight, you know what? Let's unpack that. For those that don't know me, I'm Goro Gupta, CEO and founder of Ethical Property Investments. We help everyday Aussies just like you and me invest in high cash flow ethical houses that are built to both do good and make money. We're talking real properties, real strategies, long-term thinking, and tonight I'm going to cover a hell of a lot of things. So I've got a few things on my mind. The middle income Australians are actually getting squeezed out of new property supply, and that's causing a challenge. Now, you know what? What wealth actually demands in the shifting market? Let's cover that. And why blindly following AI property advice could cost you hundreds of $1,000s. And I don't even need to emphasize how alarming that could be with you. And guess what? I'm going to be giving you my 2 cents on some of the taxes that they've announced today. And it just completely baffles me. For those that watched last week's session, you know what I'm talking about. So let's chat about what we're doing now. Now, if you're watching live, drop me a comment. If you're not watching live, drop me a comment as well. I love those things. What are we doing today? We are doing White Claw vodka soda smash 6% strawberry guava. I know it's not a beer, guys, but guess what? It's Friday, and this is my live. And hey, I get to do what we want here, right? Now I do like it cold, so I did pretty pour in the glass. I haven't had a sip of it yet. Let's give it a go. Cheers, guys. Oh yeah, much better than last week's interesting drink. Tastes a lot less sweeter, but you know what? Tastes better than White Claws I've had before. It actually has flavor, unlike some of those other White Claws that they have. And at 6%, it's delicious. They must have taken some of the feedback on. So let's chat about the shrinking affordable market. Markets reward awareness; they penalize assumption. Let's start with what's actually happening, right? We get calls every single week from people saying, "Goro, can you find me something that's $600,000-700,000 range? I want something with like 400 square meters land, 4-bedroom property, double car garage." And I completely get it, right? But here's the reality: most new properties being built today in Australia are over $1 million. And I'm going to cover why, and I'm kind of pissed off about that too, right? Construction costs are up, land price up, regulation is heavier. Developers, at the end of the day, they build where margin makes sense. Not all of them are like greedy, cigar smoking, whiskey swirling, off on freaking some lavish French holiday people. A lot of them are just people like you and me that have got a large block. And I've been talking to quite a few of them, and they go, "I'm just going to build where it makes sense." So it makes sense to build a higher level property. And that, my friends, is why the affordable segment is actually shrinking. So what happens? Teachers, nurses, tradies, small business owners, they're backbone of this country. They're getting slowly priced out of brand new supply, because once you understand how the landscape has shifted, you stop playing the game like it's still 2015. You adapt. And this, my friends, is where mindset becomes critical. And okay, I'm going to get a little controversial now. If you're ready and you're watching, drop me a line, boot me a like here, heart, whatever you want, right? Let's address the elephant in the room. Hey, usually I have an elephant. I don't have one right now, but let's address the elephant in the room. There's discussion right now around potential changes to negative gearing capital gains tax in the upcoming federal budget. Even until this morning, I was ill-informed about this, but I decided to get informed and do some digging. Here's the thing, nothing's final, nothing's legislated, but very much in the mix. And Treasury's talking about like Treasury does. Whether they put it in or not, up to them. And whenever this conversation surfaces, emotions rise quickly. Some people say, oh, housing's too expensive. We need to increase tax on those greedy landlords. Other people say, hey, I'm a landlord. We don't need more taxes. Let's slow it down and really talk about the mechanics, because property markets respond to incentives. They don't respond to taxation, right? Or they respond negatively to taxation. We've seen that happen here in Victoria. And I'm going to chat about Victoria's example in just a moment, right? But I want to point out that Victoria has not responded to the overtaxation, and we have a housing crisis, right? So what happens when you increase taxes on investment housing in a country that's already got constrained supply? Guess what? It's not rocket science, because whether we like it or not, mum and dad investors, like potentially you who's watching this, supply a large portion of Australia's rental stock. When policy settings change, it actually to make investment less attractive. The thing is, fewer new properties get built, fewer investors enter the market, existing investors hold longer, and that, my friends, makes rental supply tighten. It doesn't make it easy; it makes it harder, right? If you are a renter, you're thinking, hey, we should put all these taxes on investors, these greedy landlords. Guess what? You have less landlords. You have less rental property. And you know what? Australian property is already some of the most heavily taxed in the world. We've got stamp duty, we've got land tax, we've got capital gain tax, we've got income tax on the rental income, we've got GST embedded in construction, we've got infrastructure levels, we've got council rates. And did you know, since 2019, the cost structure of building has increased dramatically. Material costs rose, labor costs rose, regulatory costs increased, embedded taxes and compliance costs have expanded significantly. And I'm going to add on to it, right? When you layer taxes onto a new housing supply, the end result often will show up in higher housing prices, because developers and people who build these properties will need to create more of a margin to make things happen. And you know what? Housing affordability improves when supply expands. Supply expands when development is encouraged. Development accelerates when incentives align. This is not rocket science, guys. You can't add taxes and expect the average mum and dad investor just grin and bear it. Even if you say, oh, you know what? We'll only do it after the first investment property. It really discourages investments overall. We're taxed enough on property, right? Now, by the way, did you know that one of the reasons why property prices are where they are now is not because of the CGT crap that's happening? We've literally doubled taxes on buildings since 2019. That's right. We've increased taxes by over 100% on builds over the last 7 years. And you wonder why housing is magically unaffordable now. Taxes, my friends, will not fix the problem. I posit to you is what got us here in the first place. You increase taxes, you increase the rental affordability issue. P.S. Do you know that sneaky $15 billion that got recently spent on the suburban rail route CFMU? Sorry, wasted. This is the amount they identified that was wasted on the CFMU bikies and other cleaners, if you know what I mean. That scandal. That $15 billion could have built 25,000 social homes. I did the calculation myself. You know what? You want to fix the housing crisis? Build more social houses. Pay less of the damn CFMU. I told you I was going to get a little bit pissed off, because when incentives shift, capital moves. I mean, call this common sense, but more tax on investors equal fewer investors. Fewer investors equal less supply. The government's not building any housing. They talk about building 1.2 million houses. Where the hell are they? Look, at the end of the day, money's like an energy, and capital flows where it's treated well. Treat money well, and that goes both for personal and government policy alike, right? Now, I want to shift gears a bit, but I need a drink after that little rant. Lucky it's a drink I like. If I didn't like, I would have actually gone harder. So, you've probably heard this saying before from Tony Robbins. If you followed Tony Robbins, you followed me for a while, even I use it all the time, right? Take massive action. Well, you know what? Building wealth demands smart goals and bold habits instead of endless planning. So let me break this down for you, because I want to give you something that's, do a little bit different. You have to have property and this and that. I want to give you some mindset stuff. Let's break it down to something practical for property investors like you, right? Number one, Get specific about your target. Look, we all want to build wealth, right? But just don't say, I want to build wealth. Let's get specific about it. Tony Robbins says, here's $1, get out of here. You've built wealth. Right? That's not what you want. Let's get specific about it. Say if you're going to do an incantation, meditation, what have you, in 5 years' time, I want $80,000 net annual cash flow from property, right? Because clarity, my friends, create focus, as Tony says. Decisions create outcomes, and wealth and mindset responds to specificity. Freedom is actually engineered. Financial freedom is actually engineered. And I'll tell you why. Because we have this thing called the reticular activating system, right? The reticular activating system brings things to us. They talked about in The Secret and all that. But let's talk about the science behind it. Your brain doesn't know a lot of times whether you're lying or telling the truth, right? And so what happens if you say, if you're looking for, let's say you just buy a BMW, Mercedes, Toyota, whatever you've just bought, right? And you start seeing more of those cars on the road in the same damn color as yours. Why? Because your brain is all of a sudden not distorting or generalizing those things. And so what our reticular activating system does, its job is to delete, distort, and generalize all the data that's coming in and filter the like 2 billion bits of data through to our conscious and subconscious brain, right? Or other than conscious, as some people call it. So with your RAS, if you're going to, that's why incantations tend to work, right? You still got to do the work for it. And, what I call the fourth law of The Secret, which is letting go. But, if you're going to talk about it, be specific. In 5 years' time, I want $80,000 net annual cash flow for property. That's a lot better than I want to build wealth, right? Number two, let's talk about replacing passive habits with compounding habits. Now, most investors spend months scrolling listings, watching the headlines, reading the news. And you know what? They also take this barbecue advice bullshit, right? Instead, work on improving your borrowing capacity. There are guys on Netflix who teach you how to do debt structuring and study market cycles. Talk to experienced investors. Talk to people who've actually made money, not just in the last property cycle, but people that are like 20, 30 years worth of wealth, not just the last 5 years worth of wealth, because that doesn't mean a cycle, stuff could go sideways. Shit could happen. And the people that have invested for 20, 30 years know how to handle it. Because skill building compounds, waiting does not. Right? Now, number three, define what freedom actually means to you. What does financial freedom look like? We've done a little bit of content on 5 levels of financial freedom. If you want to know more, check out our page or even drop a comment here. I'll, happy to send you those 5 levels of financial freedom. Now, for me, true freedom is really simple. Your investment covers your basic living costs. Your time becomes optional. Work becomes a choice. You don't have to worry about surviving every day, right? And you know what? I do a hell of a lot of work. I love working and doing what I do. And I also, over this last few months, have enjoyed taking a bit of a back seat on things because, life got in the way. I literally had over the last 3 months, 4 weddings and a funeral. But I was able to take a little bit of time off. And, it didn't become something that I was seriously stressed. But yeah, I still worried about it because that's just my nature. But I was able to do the things that really mattered. And that sort of stuff doesn't come from endless planning. It comes from informed, decisive action. Now, here's the danger behind what I'm talking about, right? Taking action without wisdom can be just as risky, if not more, than taking no action at all. Massive action, intelligently directed, creates massive results. And this is where AI enters the conversation. Before I bring AI into it, let me get onto this. AI, my friends, is everywhere. It's powerful. But if you blindly trust AI for property investing, it can destroy your portfolio. I saw something crazy, which I'm going to share with you, right? Technology accelerates decision, but wisdom directs them, right? Let me tell you a quick story. Just last week, someone came to me and said, Goro, I checked out this ChatGPT thing, and one of the best places to invest in, it said Darwin was one of the most overlooked locations. And I said, no, dude, are you crazy? Darwin has historically been one of the most volatile markets in Australia. We've had booms, busts, oversupply, sharp corrections, you name it, Darwin's had it. Now, if you've lived through the cycles and understand the market, you understand the risk. But the thing is, AI doesn't live through cycles. It lives in the moment. It aggregates data And data without experience can be dangerous. You know, among the many ways, there are three ways I want to talk about that AI can actually mislead. Sorry, just starting it. Among the many ways, there are actually three different ways AI can mislead property investors. Number one, it overemphasizes surface metrics. AI loves yield percentages, median growth, trend graphs, but it doesn't feel tenant quality, it doesn't assess demand durability, it doesn't elevate future supply risk properly. Numbers without context can mislead. Now, number two, it lacks on the ground nuance. AI doesn't pound the pavement, it doesn't walk the suburb, it doesn't speak to local agents, it doesn't see the development pipelines forming before they hit the public data. It can't walk through the suburb, go, hey, that's available, that's available, that's available. Actually, you know what? This is going to be a great development block because of this, and this. Experience, honestly, she shifts before spreadsheets can confirm them. And number three, AI treats property like a short-term trade. My friends, property isn't crypto. It's not a 12-month flip. It is, for a lot of people, for me personally, it's a 20-year strategy. It's debt management, it's risk buffers, it's cash flow resilience. And you know what? AI can calculate some of these scenarios, but it doesn't carry the emotional and financial consequences of being wrong. Now, don't get me wrong. AI is cool. It's incredible. We use AI in our business all the time. It improves efficiency. It speeds up research. It makes operations smoother. But when you're deploying hundreds of thousands of dollars, you 7 or 8 figures. Oh, not 7 or 8, but 6 and 7 figures. You need judgment. You need lived experience. You need pounding the pavement. You need pattern recognition across cycles, not just in the moment. And that's why working with experienced teams and experienced mentors and strategists like, ethical property investment it matters, right? Guidance doesn't replace data, it interprets it, and it interprets it so you can make the best of it. Now, I want to chat about the housing crisis. I told you I'd be covering a lot of content today. I think it's already been our longest property interviews for a hell of a long time. Now, if you want affordability, increase supply, because when you build more home, pressure eases. Now, here's something that might sound a little bit controversial, but it needs to be said. Many government policies are actually making the housing crisis worse. We see constant debates about tax changes and this and that, and incentives and redistribution of wealth, right? But the reality is these often don't increase housing supply. And without supply, affordability doesn't improve. You can't tax your way out of a housing shortage, but you can build your way out. And this is where private investors like you and I play a critical role. Without investors like us, who funds these new housing? Without capital, who takes a risk? Without development, where does that new supply come from? The power of the people is so much so it can change the world, right? Policies that discourage investments reduce the risk of new homes being built, and that pushes prices higher over time. Now, let me be clear. If we want more affordable housing, we need solutions that increase supply in a sustainable way. And you know what? This is where co-living, I believe, becomes incredibly powerful. Co-living increases housing supply without waiting for massive land releases. It improves affordability for renters and actually creates strong, sustainable cash flow for a lot of investors. It allows more people to live in the communities they want to be in the areas they sort of want to be in, without being in the middle of the bush somewhere. And you know what? One property can house multiple tenants. I was speaking to potential investor today, like, I've never heard of this co-living thing. Wouldn't people want their own space? Like, yeah, but a lot of people can't afford it, especially a single or a couple. If you've got kids, co-living is probably not the right setup for you, right? But if you're a single or a couple, co-living could be a good option. That time to save that deposit to buy your own home, right? It reduces the pressure on the broader market, and it really supports workplace mobility because people can live closer to their work. And if they've got another home, they can actually go travel back home. And really, it creates win-win outcomes. Look, as I said, you build your way out of shortages. And that, my friends, is ethical investing in action. Doing good and making money at the same time. And that's why we're excited about what's coming up next. We're going to be doing another webinar in March, this time entirely focused on co-living. Our SDA one went gangbusters. We had so many positive responses. So I'm like, we've got to run another one, talk about co-living, where we're going to break down the numbers, the risks, the compliance, and the real opportunities in the space. So make sure you stay tuned, because this is something serious investors like you need to understand. Capital aligned with ethics can change the world. Now, before we wrap up, let's chat about some key takeaways. Tonight, we talked about the reality of today's market, understanding the system and then playing it better. That's right. Here's how you work it. Understand the system, then play it better. It's not rocket science, but it works. How middle-income Australians have been slowly pushed out of the new property supply, and why understanding that shift is critical if you want to stay ahead, right? You can't play with 2019, 2018, 2015 rules anymore. We spoke about taking massive intelligent action and setting clear targets, building the right habits, and defining what freedom actually looks like for you. We unpack the dangers of following blindly. Let's say that. We unpack the dangers of blindly following AI and why experience, judgment, and real-world cycles still matter when you're making life-changing financial decisions. Because long-term thinking creates long-term wealth. What a concept, right? We've also explored the increasing housing supply through ethical investing and innovative strategies like co-living, which I believe is part of the real long-term solution. I'll be chatting more about that at future Properties and Beers. And look, the market's shifting. Affordable supply is shrinking. The gap is widening. It's time for clarity, action, and experience guidance. Now, here's something important. Most of you watching right now haven't hit the follow button yet. You tune in, you watch, you engage, but don't follow our page. And that means you're missing out. Your market breakdown, strategy sessions, really cool stuff that we post on there, right? We post consistently. And you know what? Most of all, we protect everyday investors from costly mistakes. So if you're serious about going ahead, follow on Facebook and Instagram, Ethical Property Investments. And don't miss out because you didn't click follow. Stay informed, stay strategic. And remember, invest ethically, do good, and make money. Thank you for joining me tonight. See you at the next Properties and Beers. Cheers.